Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about NUVATION Bio Inc. Annual Report. NUVATION Bio Inc. is a clinical-stage biopharmaceutical company focused on developing therapeutic candidates for oncology. At the forefront of its pipeline is taletrectinib, an ROS1 inhibitor designed to treat patients with ROS1 plus non-small cell lung cancer. In addition to taletrectinib, the company is also advancing several other promising products. Safusidenib, a mutant isocitrate dehydrogenase 1 inhibitor, is currently in Phase 2 clinical trials. NUV-1511, a drug-drug conjugate, has shown potential in suppressing the growth of advanced solid tumors during chemotherapy. The company's portfolio also includes NUV-868, a binding domain 2 bromidamine and extraterminal inhibitor that targets bromidamine-containing protein 4. These innovative treatments aim to address various types of cancer, showcasing NUVATION Bio Inc.'s commitment to advancing oncology research. Overall, the company is providing several businesses and services in the biopharmaceutical industry, including developing therapeutic candidates for oncology, conducting clinical trials for its lead product candidates, providing drug-drug conjugates for chemotherapy agents, inhibiting mutant isocitrate dehydrogenase 1, and bromidamine-containing protein 4 to suppress tumor growth. Unfortunately, I don't have access to the text you provided. However, I can still provide a general overview essay on what might cause a stock price to skyrocket. The stock price of a company like NUVATION Bio Inc. can skyrocket due to various factors that demonstrate its growth potential and financial stability. One key reason is the development of innovative products or services that meet emerging market demands. When a company successfully introduces a groundbreaking technology, it can attract significant investor interest, leading to an increase in stock price. Another factor contributing to a surge in stock price is strong revenue growth. Companies with consistent and increasing revenue streams are often seen as attractive investment opportunities by investors. This is because they demonstrate the ability to generate profits and expand their market share. Additionally, partnerships or collaborations with other reputable companies can also boost a company's stock price. When two established players join forces, it can create new business opportunities, increase market presence, and enhance credibility, all of which can positively impact investor sentiment and drive up the stock price. Furthermore, positive news coverage and media attention can also contribute to an increase in stock price. Favorable reviews, awards, or recognition from reputable sources can generate buzz around a company, attracting more investors and driving up demand for its shares. Lastly, changes in market trends or industry shifts can create opportunities for companies that are well-positioned to capitalize on them. When a company is at the forefront of an emerging trend, it can experience rapid growth and increased investor interest, leading to a surge in stock price. NUVATION Bio Inc. market capitalization of $2 billion is materially smaller than most of its industry peers of roughly $2 billion. NUVATION Bio Inc. trades at a higher price-to-book ratio of 5.37 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 14% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth for a company can be identified through an analysis of its financial statements. In this case, the data reveals that product revenue and collaboration and license agreements revenue have significantly increased from 2024 to 2025. Product revenue jumped from $0 in 2024 to $24,000, $663 in 2025, while collaboration and license agreements revenue rose from $7,873 in 2024 to $38,239 in 2025. This substantial growth in revenue is a key indicator of the company's financial health. The total revenues also saw an increase from $7,873 in 2024 to $62,902 in 2025, indicating a significant expansion in the company's business operations. These figures suggest that the company has successfully diversified its revenue streams and expanded its product offerings, leading to increased sales and revenue growth. The net income of the company has experienced a decline due to various factors. Initially, there were no significant changes mentioned on page 27. However, by page 31, it was noted that the company may not be profitable in the near term or at all due to commercialization challenges and competition from established companies. As time progressed, the net income continued to decrease. By page 34, pricing pressures, government programs reducing reimbursement rates, and intense competition were identified as contributing factors. The lack of revenue generation and significant expenses on page 39 further exacerbated the decline in net income. The profit margins also suffered a similar fate. On page 31, it was mentioned that commercialization challenges and competition from established companies may affect profit margins. By page 34, pricing pressures, government programs reducing reimbursement rates, and intense competition were identified as reasons for decreased profit margins. The main reasons behind the decline in net income and profit margins include governmental scrutiny of drug pricing, commercialization challenges, smaller market opportunities, pricing pressures, high development costs, regulatory requirements, and uncertainty around product demand and reimbursement. These factors have collectively contributed to a decrease in both net income and profit margins. The company's financial performance indicates a positive trend in its operating cash flow. According to the data, the company has consistently generated significant amounts of operating cash flow over the past 2 years. In 2024, it recorded $2.6 million, and in 2025, it achieved an even higher figure of $2.5 million. This demonstrates the company's ability to manage its operations efficiently and generate substantial cash from its core business activities. The company's debt level has undergone significant changes between 2024 and 2025. According to the financial reports, the debt level increased substantially in 2025 compared to the previous year. This increase is attributed to a $150 million investment from Sagard Healthcare Partners through a revenue interest financing agreement, resulting in a liability of $155,404 as of December 31, 2025. Additionally, the company entered into a $100 million senior secured loan agreement with Sagard Holdings Manager LP. The interest expenses have also seen a substantial increase in 2025 compared to 2024. The total interest expense for 2025 was $13.7 million, a significant jump from the previous year's figure of $341,000. This represents an increase of $13,341,000, indicating that the company is now shouldering a much heavier burden of interest expenses. The management of the company is expressing concerns about its financial outlook due to significant expenses and increasing operating losses over the next several years. Despite these challenges, they are optimistic about revenue growth from commercialization and sales of their product candidates, including IBTROZI. To support this growth strategy, substantial additional funding will be required. The company has entered into a revenue interest financing agreement with Sagard Healthcare Partners, providing $150 million in funding and tiered royalty payments on U.S. net sales of IBTROZI. This partnership is expected to drive revenue growth and help the company achieve its strategic focus on product development, commercialization, and partnerships. Financial projections indicate that existing cash will fund operations for at least 12 months, but additional funding may be necessary in the future. Revenue growth is anticipated to increase significantly from 2024 to 2025, driven by product revenue, collaboration and license agreements revenue, and interest income. The company has made several strategic moves through acquisitions and divestitures. In terms of acquisitions, the company has purchased Panacea Acquisition Corp. and Enhart Therapeutics Limited, with NUVATION Bio being merged with Panacea. Additionally, an in-process research and development asset was acquired, resulting in a charge related to the acquisition. On the other hand, the company has also made divestitures, including the out-licensing of commercial rights to taletrectinib in various territories such as China, Japan, Europe, and others. Furthermore, strategic partnerships or divestitures have been announced by competitors, indicating a shift in the company's focus and strategy. The company's financial activities have been highlighted through various summaries. One notable point is that the company has engaged in share buybacks, as mentioned on page 43. This indicates a strategic move to reduce the number of outstanding shares and potentially boost shareholder value. In terms of dividend payments, there is no mention of any such activity on page 40. Furthermore, it is confirmed that the company does not intend to pay dividends in the foreseeable future, as stated on page 88. This suggests that the company is prioritizing other financial objectives over distributing profits to shareholders through dividends. Concerns about inventory buildup and supply chain disruption are evident in several areas. On the inventory side, there is a notable increase of $11.4 million in 2025, indicating potential stockpiling issues. This could lead to wasted resources and reduced cash flow. Regarding supply chain disruptions, multiple factors pose significant risks. The reliance on third-party distributors, specialty pharmacies, and vendors creates vulnerabilities that could impact revenues and operations. Manufacturing supply chain failures could delay or cease clinical trials, while regulatory changes, government funding shortages, and global health concerns can disrupt the entire supply chain. Health epidemics and governmental measures can further exacerbate these issues, causing labor shortages, global supply chain interruptions, and increased costs. Tariffs on pharmaceutical products from China may also increase expenses and reduce profitability. The uncertainty surrounding tariffs complicates long-term investment decisions, while trade disputes and tensions between countries can lead to unfavorable macroeconomic conditions. Overall, the potential for inventory buildup and supply chain disruption is substantial, with multiple factors contributing to these risks. Addressing these concerns will be crucial to ensuring business continuity and mitigating financial losses. That concludes the financial summary for NUVATION Bio Inc. Feel free to comment below, and I will be happy to answer them when possible.